All right. Today is Tuesday, the 17th of January, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. What's going on in the world right now? Besides the satanic cult meeting at Davos, and of course, I'm listening to them all day long, and all they talk about is human rights and democracy, and then with the same breath, they talk about how they love doing business in China. And they're also talking about, hey, this is not going to be as bad as they told you before. What recession? What are you talking about? Actually, the global economy is going to be beautiful with a lot of opportunities out there.
The best hope is that the inflationary process seems to be going quite well. We'll have an important report out in the employment cost index at the end of the month, but it seems to be going quite well. And if that were to continue, that is the best hope for the economy in 2023, because it would mean that the Fed could pivot.
I see that, we have a strong market still, job market, even in areas where you saw layoffs in the tech sector. Many of those folks are finding jobs right away. They're finding other jobs in areas that, quite honestly, are looking for tech people.
Despite the macroeconomics in the short term, I think digital transformation is accelerating at virtually every industry. The future of the economy is digital.
I think we're starting to bottom out in public market valuations for some of these tech companies. It's got to get reflected in the private markets. I think we'll start to see some very attractive opportunities in the next 12 to 24 months.
Maybe they're talking about the opportunities for the 1%. Because remember, every time we have a crisis, quote unquote, the Fed comes to the rescue by printing trillions and trillions and trillions of dollars. And the excuse they use every single time is, oh, we can't let people lose their jobs. We can't let people lose their homes. What about the poor, the middle class? Where's the humanity? Meanwhile, all of these operations, these rescue operations that were meant for the poor and the middle class, they always end up benefiting the 1%. And this is exactly what Oxfam said yesterday, that the richest 1% of people amassed almost 2/3 of the new wealth created in the last 2 years. In other words, all of these trillions and trillions of dollars that they said, oh, it's meant to mitigate the risk from the thing and help the poor and the middle class. Well, all of that money ended up going to the top. On the other hand, regular folks ended up holding the bag. And when the cult at Davos talks about, oh, the economy is doing pretty good, stop being too dramatic here. We're not going to go into a recession. Lots of opportunities out there. You mean the opportunities according to the New York Fed, for example, who just released this morning the Empire State Manufacturing Index, and it was absolutely abysmal. The reading went down to negative almost 33. This is lower than the great financial crisis, and almost as low as the thing shutdown, which we now know, we all know, that had that crisis materialized the way they were projecting, when they were panicking, of course, it would have been way worse than the great financial crisis. It would have been way worse than perhaps even the Great Depression. And now the reading in the Empire State Manufacturing Index is heading all the way down to meet the 2020 lows if this continues. So, soft landing, you say? I say, folks, buckle up, because if this is a leading indicator, it is saying that the crisis that we avoided back in 2020, courtesy of the Fed printing machine, well, now we're going to have a revisit to the same crisis once again. Only this time around, the printing machine will not come to the rescue because we have inflation. And here's more soft landing news for you. We continue to monitor the tsunami of layoffs, and this time around, we got the news from Microsoft, which announced today axing about 11,000 jobs. This is what a soft landing looks like, right? And folks, these organizations have no shame at all. They do these layoffs in the most brutal way possible. For example, we talked about the Ohana bullshitter, Salesforce CEO Mark Benioff, who plays this Ohana bullshit act as, oh, we're all familia here, we're all take care of each other, really? Because he got rid of thousands of employees, and then he comes out late to the meeting joking around. Did I miss anything? He says. But folks, that leads us to the main subject of tonight's program, which is Goldman Sachs. We talked about the layoffs by Goldman Sachs. Thousands and thousands of employees, poof, gone. And we talked about the brutality in the way they conduct these layoffs. They dupe employees. Hey, we just have a meeting. You have to attend at so-and-so time. The employees attend only to find out that this is not a meeting. This is not a conference. Instead, it is a trap to say, hey, you just lost your job. we're sorry, goodbye. And ladies and gentlemen, all of these layoffs are indicators of trouble. All of these layoffs are indicators that these companies are facing massive problems when it comes to margins. So all of this bullshit talk at Davos that, oh, the worst is behind us, we have a soft landing coming, and there are opportunities all over the place, when in reality, companies are now resorting to mass layoffs because they realize that their margins are getting crushed big time. And of course, when it comes to Goldman Sachs, it is absolutely brutal because you have all of these recent graduates from the Ivy Leagues and such. They're already in student debt, thousands and thousands of dollars, but they apply to Goldman Sachs and they endure, shall we say, inhumane conditions just to have Goldman Sachs in their resume. And frankly speaking, I see this as a liability. If you want a job from me and I look at your resume and I see Goldman Sachs, that's a red flag. Because once you work in Goldman Sachs, you're stripped away from humanity and you need to be reprogrammed back into a human being. And the tragedy in these layoffs in Goldman Sachs, they're impacting these junior analysts who gave it all up just to work in Goldman Sachs. Now they're losing their jobs after they've been overworked and underpaid by Goldman. To begin with, the organization is in chaos. Goldman Sachs used to be a professional organization, it used to be a prestigious organization. But once they started adopting this stupid mantra of Silicon Valley, of hey, you don't need to wear a suit anymore. You can come and work here in your pajamas. And I say, are you selling financial products or are you selling hot dogs? Professionalism matters. But Goldman Sachs is setting an example that professionalism doesn't matter. The CEO is out there DJing. What do you think is going to happen to Goldman Sachs? The answer is absolute disaster. And we got the evidence today from the earnings that they reported in the morning. And give us a live shot at Goldman Sachs stock and let's take a look. And ooh. Ho, ho, ho. Down over 6% in a single day. The stock of Goldman Sachs lost over $24 in a single day. And this has impacted the Dow negatively. The Dow was down over 300 points thanks to Goldman Sachs. So let's talk about it, and here it is. In focus tonight. Ouch. What a disaster from Goldman Sachs. You see, in the morning, we got the report from Goldman, and the headline reads, Goldman Sachs posts its worst earnings miss in a decade as revenues fall while expenses rise. A bad combination. Margins are getting squeezed. No wonder why Goldman is now looking to reduce their expenses by conducting mass layoffs, because they cannot increase their revenues anymore. That's a no-go. They have to reduce expenses. This is a leading indicator to a lot of organizations out there. When the avenue of increasing revenue, meaning price inflation, is gone, they're gonna have to resort to reducing their expenses. And the easiest way any company can do that is by conducting mass layoffs. So when the geniuses and the experts, quote unquote, say, hey, we might have a soft landing in the economy because the employment market remains intact. Maybe it is intact for now, but it's about to get shattered. And of course, Goldman Sachs blames challenging U.S. economy on the disastrous report that we got today. It's not the management. It's not the fact that we're selling hot dogs in Goldman Sachs. We're going to blame it on the economy stuff, the Fed, Jupiter, Mars, something, but not us. And I say if that was the case, then how do you explain the fact that Morgan Stanley did pretty good? Now, I'm not saying it was a good report. I'm just saying it was a lot better than Goldman Sachs. Goldman Sachs was an absolute disaster. To begin with, Goldman Sachs says in the report for the year that was 2022, net revenues were $47.37 billion for 2022, and that is 20% lower than a strong 2021. Now, why would Goldman Sachs use the word strong? What is the implication of using such a word? The answer is to say, hey, the report that we just got out, we made $47.37 billion last year. That's not bad at all. It only looks bad if you pin it against last year's number, which was an outlier, because we had a stock market mania or whatever. And of course, in the report, they're not giving us the ratios by geography. Maybe they're embarrassed about it, so I'm going to do the job for them. And here it is for the Americas, revenues down by 30%. For the EMEA region, down 12% on the year. For Asia, down 31% year on year. Unbelievable. Maybe they should start selling hot dogs. Maybe they can fix the revenues that way instead. Because here's the problem, folks. When we look at the fourth quarter, the sheet, what do we see here? Net revenues in Q4 2022 were down by 16% versus last year, or shall we say 2021. On the other hand, expenses went higher by 11% year on year. So you put two and two together, your revenues have a negative growth rate, your expensive have a positive one, and the margin between both is 27%. The gap between revenues and expenses, 27%. All in all, the net earnings for Goldman Sachs doesn't take a genius to figure out they're down by 66% year on year.
Oh my God!
Unbelievable. So folks, the recent layoffs that we've seen in Goldman Sachs, that is just the beginning. To fix this margin problem, Goldman Sachs will have to reduce their expenses by a lot, and that means more layoffs to come. Perhaps thousands and thousands of jobs will have to be cut. Now, when we look at the most important segments for Goldman Sachs, global banking and markets come in mind. And we're talking about Q4 of 2022. Net revenues are down by 14% year on year. Investment banking fees down by 48% year on year. Unbelievable. And the only bright light here is the FICC. This is the fixed income. That is up by more than 44% year on year. And the reason is, listen to this, higher net revenues in interest rate products and commodities and higher net revenues in credit products, meaning thank you to the Fed raising interest rates higher. That covered some of the problems in Goldman Sachs because they can charge a higher interest rate. And thank you to the rally in commodities. Now, absent of that, the revenue for the unit would have been a lot worse than being down 14% year on year, because even in equities, revenues were down 5% year over year. Now, when we look at the other important segment, the asset and wealth management, net revenues were down by 27% year on year. Unbelievable. When it comes to platform solutions, that was the only positive segment for Goldman Sachs, but the problem is it is a much smaller segment than wealth management, and of course, a lot smaller than global banking. In the fourth quarter of last year, the revenue for platform solutions was up by 171%. So there is one growth engine in this company, that is platform solutions. But here's the catch. The increase in consumer platform net revenues primarily reflected significantly higher credit card balances. Whoops. In other words, for now, the higher balances on the credit cards, Goldman can capture a higher interest rate. But if the clients default in these high credit card balances, Goldman is not going to be able to charge shit. And instead, the company will have to resort in using its provision for credit losses, and they have plenty of that. Now, here's the problem, folks. Maybe you're not doing business with Goldman Sachs, but interest rates across the board, specifically for credit cards, are surging like we have never seen before. And that means as consumers continue to rack up more and more and more debt, rates continue to move higher and higher and higher. Now, these credit card companies are not going to push the rates down because, oh, the 10-year yield went down, or, oh, the Fed is slowing down rate hikes from 75 to 50. If they can get away with it, they'll keep these rates as high as they can. In the meantime, what does that mean for the consumer? Especially when you factor in that the balances are rising higher. It means the consumer will have to pay more in interest to service these loans and credit card balances. All of that money is being taken away from the consumer's ability to use their disposable income to stimulate the economy by spending on restaurants, on bars, on products and services. That is recessionary. That's what they're not telling you when you hear these geniuses in Davos talking about, oh, the worst is behind us. What are you talking about? The worst is yet to come. And with that positive note out of the way, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 391.76 points, or a decline of 1.14%. Thank you once again to Goldman Sachs. On the other hand, the Nasdaq closed positive by 15.96 points, or a gain of 0.14%. The S&P with a modest loss here of 8.12 points, or a decline of 0.20%. When we look at the sector's performances today, coming up at number 1 and capturing the gold medal, technology, or shall we say NVIDIA, because that's the one that really contributed to all of this. But at number 2, capturing the silver medal, energy. Energy is closing the gap. Little by little, energy's taking the lead. But at number 3, capturing the bronze medal, real estate. On the other hand, the laggards of the day, look at this. The winner for the year so far, materials, is actually lagging today big time. And the reason is gold miners went down after an impressive rally year to date. And then we have communication services also been the leader as of late. And then industrials, another leader year to date, all lagging for the day. In other words, the outperformance of technology today is a trap. And the reason is the rally in NVIDIA is getting closer and closer to becoming overbought, which means it is susceptible for a massive pullback. When it comes to the advance to decline ratios, NYSE 47% advancing versus 52% declining. The Nasdaq 49% advancing versus 49% declining. Now, we talked about how the ratios will have to move down around the 50, even below. And this is exactly what we're seeing right now. And the reason behind this is profit taking. A lot of folks who made money chasing the rally year to date, now they're booking some profits and taking chips off the table, as everybody should. If you played this rally, it has been good for you, you gotta take some chips off the table. When it comes to commodities, look at this. The dollar did not move one way or the other today. It was pretty much flattish, but the message is clear. If the market will make the mistake of, we're heading into a soft landing, the economy will not be damaged, inflation is subsiding, and we should buy and loosen financial conditions, you think that will come without a revival in inflation? Think again. Look at what happened today in crude oil futures, for example. Both of them above 80 once again. Are you watching this, President Biden? Are you watching this, Brian Deese? You say you want to refill the SPR under $70 a barrel? I say good luck, brother. Not going to happen. Are you watching this, Jerome Powell? Are you watching this, the good professor from Wharton, who says that inflation is over? Are you watching this? The WTI closed the day with gains of almost 1.5%. Brent, on the other hand, with gains exceeding 2.5% for the session. Gasoline RBOB up by over 1%. Heating oil up by over half a percentage point. We have a rebound in natural gas worth about 7% for the day. Now, we talked about the news from Reuters last night that perhaps the Freeport LNG facility will extend its hiatus all the way till February. And I said, look, we are the number one country in the world, the richest country in the world, the most powerful country in the world. And we have one of our top natural gas processing facilities shut down for how many months now? And we can't get it back on track? Well, now we got the correction by Reuters, and they say that they're seeing gas starting to flow to Freeport LNG, which means perhaps it is back on track, baby. What do you think that means? It means natural gas is about to bottom, move higher again. Now, unfortunately, I made the mistake last night of tweeting the ticker BOIL, which is a levered index for natural gas. I should have explained more on how to play this one. So I'm going to do that in the heat map analysis, and I'm going to show you exactly how to play the rally in natural gas if you do believe that we have seen the bottom in natural gas, at least for now, based on this news. Now, back to the futures, we're seeing a mixed reaction when it comes to softs, mostly negative, led by lumber, but we also have losses in OJ, coffee, and cocoa futures, be it modest losses. Yet on the other hand, we have gains led by sugar futures, worth about 1.75%, and then more modest gains for cotton futures, worth a little more than half a percentage point. On the other hand, maybe profit taking in metals, because they've been the leaders year to date. Now, does that mean that we're about to see a rebound in the US dollar? Is this the message for metals futures today? The answer is it could be. But even without a rebound in the dollar, what we're seeing right now could be taking profits out of metals, gold, silver, even copper, and rotating some of these profits into energy. So we're seeing gold, silver, platinum, palladium all down. The exception is copper, up by about half a percentage point. We talked about copper in details. Copper, unlike palladium, and unlike gold and silver, it has another catalyst moving it higher, and that is the reopening in China. When it comes to meats, muted across the board. Of course, the notable loser, once again, feeder cattle, down by almost 1% for the day. But look at grains, a rebound across the board. The exception is rough rice futures, down by a little over 1%, but we have gains north of 1.5% for corn, oats, all closing in the positive side. And we also have soybeans, soybean meal, and soybean oil futures also closing positive. On to the big casino, the options market. What do we see here? The volume is moving down. What does that mean after a big rally so far? The answer is uncertainty by traders. Traders are not sure. They've seen enough for now, but it is a pivotal point in this rally. Does it continue or does it pull back? What are options traders seeing right now? The answer is they're looking at the chart of the SPX. We're now exactly at the sloping line of resistance. A break above, a close above will reignite this rally. A pullback from this point on will reignite the fears that all what we've seen so far was a mere bear market rally, and we stop exactly at the same resistance we've stopped before over and over and over again. So for now, it is the calm before the storm, but it doesn't mean The traders are betting that the market will go one way or the other. For now, we have uncertainty. Wait and see. And it is reflected by the drop in volume all in all across the table today. Now, with that being said, the hottest table by far, as always, Tesla, the souffle with around 1.7 million contracts traded today. It is split almost 50-50 between puts and calls, yet the name is rallying by more than 7% today. And at number 2, Apple, with around 850,000 contracts traded today. About 53% of those were calls. Notice that they're buying more calls in Apple now. Is this a leading indicator that Apple is about to move higher again? And if Apple marshes higher, it means that the market will marsh higher too. But at number 3, Amazon, with around 800,000 contracts traded today. About 51.5% of those were puts, not calls. Now, Apple has been the laggard, along with Microsoft, of course, but Microsoft has been outperforming in the last couple of days. Is Apple the sleeping giant here? In other words, can Apple move higher and replicate the outperformance by Amazon? I doubt it. I say what we're seeing right now is hedging one way or the other just before earnings. I don't think the traders are going to make big bets one way or the other. But if you short Apple, your hedging strategy is to buy calls before earnings, just in case we see a pop in the stock. Likewise, if you long a stock, you're buying put options right now just in case we see the stock that you own going down right away after earnings. You can buy puts. That's your hedging strategy. So we're not going to read too much into the action today. Now, with that being said, let's move on to the unusual activities that took place in the options market today. We start with the ticker UBS for, you guessed it, UBS. Now, we have somebody who sees the name pulling back and they bought the $20 puts for the expiration date February 17th, with expectations that the name could move down and lose more than 5.5% of its value by then. They paid around 30 cents a piece to enter this trade, all in all spending around $500,000. And then we have the ticker GDX down for the day, but somebody's buying the dip right away. And they bought the 36 calls for the expiration date March 17th with expectations. The GDX, the ETF for gold miners, could gain more than 14% by the expiration date. They paid around 50 cents a piece to enter this trade, all in all spending around $375,000. What about the ticker IWM for the Russell 2000? Somebody's buying the dip right away, and it wasn't really that much of a dip anyways. In this case, they bought the 204 calls for the expiration date March 17th, with expectations that the name could move higher and gain more than 9% by the expiration date. They paid around $1 a piece to enter this trade, all in all spending around $750,000. Last but not least, at the bottom of the table, what about the ticker CNC for Centene? Somebody sees the name moving higher and they bought the 85 calls for the expiration date March 17th, with expectations that CNC could move higher and score gains north of 11% by the expiration date. Now, they paid around $1 a piece to enter this trade, all in all spending around $600,000. On to the heat map analysis. What do we see here? The outperformers continue to be technology and chips, in this case specifically NVIDIA. But look at the pullbacks. Used to be outperformers last week, now underperformers so far. We are, of course, talking about banks. Banks are down, communication services, including names in the big caps such as Google and Meta. Even Netflix is down. The recent outperformers in Chinese stocks, Alibaba, JD, Pinduoduo, all down, along with the EV manufacturers, Li Auto and NIO. Another outperformer of last week, Amazon, down by about 2%. And of course, one of the biggest outperformers for the year, gold and metals, down big for the day. So we're seeing profit taking here, folks. Even industrials, names such as Boeing, Honeywell, Triple M, all down for the day. They're taking profits from the recent rally. Reason number one, the technicals that we just talked about, and we're going to talk about it again in a minute, but reason number two, why not book some profits after an impressive rally as we head into a perhaps consequential earnings season? This is the message of the day. Now, of course, the notable outperformers, we talked about NVIDIA, but we also have Tesla, up by over 7%. Tesla has been hammered, so I'm not surprised to see it being the exception to the upside in a down day all in all. Now, let's talk about some corporate news, because among the underperformers, once again, healthcare, be it UNH, we talked about this. The name is a short from this point on, but we also have Pfizer, a name that I'm still long, but I'm debating getting out and cutting my losses here. It has been a brutal start of the year for Pfizer, and we have more bad news. The CEO of Pfizer says that they're now offering the jab for the thing which is, by the way, absolutely delightful. How delightful it is, Maverick? It will melt your heart, literally. They're going to offer this thing, the delightful thing, to poorer countries, and they say not for profit. They're not going to make any profits from handing out these jabs to poorer countries. Now, this is not a good move business-wise because it means they're not making profits. Now, do I want to be in a company that is not making profits? Probably not. So what am I going to replace Pfizer with? Am I going to go back to AbbVie? Am I going to perhaps buy the dip in Merck? Or am I going to buy Johnson & Johnson? Perhaps Bristol Myers? Or perhaps leave the guessing game out of the picture and just buy the XLV? I'll think about it. And then we have news regarding Disney. Once again, an update about the battle between Nelson Peltz and Bob Iger. One thing you should be aware of, Bob Iger is a cult of personality. In other words, Bob Iger owns Disney. Even when Bob Chapek was the CEO of Disney, everybody knew Bob Chapek is a tool, and the de facto leader of the organization remains Bob Iger. Disney have the tendency of having these long tenure CEOs. From Eisner, and after the Eisner administration, it was a hard transition to buy Bob Iger as a CEO, but he's brutal, and he made it happen. The transition out of Bob Iger is not going to be easy, and he's back. You think Nelson Peltz will be able to break all of this? Think again. This is not a small-time company where, somebody, activist investor such as Carl Icahn can just get in and do whatever he wants and create chaos. It doesn't matter who Nelson Peltz is. It doesn't matter how rich he is. Disney and Bob Iger will say, hey, buddy, take a hike, get lost. Who do you think you are? In other words, this is a battlefield stock. You don't want to be in a battlefield stock. And then let's talk about some auto news, and we start with Carvana. Carvana jumped higher today on the news that it is adopting the poison pill. Now, every time you hear a company adopting the poison pill, it is a sign that the next step will be bankruptcy. So whatever pop you get out of Carvana, it's going down to zero. Now, do I recommend that you short at this point? The answer is absolutely not. Reason number one, it is so expensive to short Carvana right now, it doesn't make sense. Shorting this name should have been back in 21. Number two, you're gonna see a lot of these news, and a lot of shorts will scramble and cover. Now again, does that mean you go long Carvana? That's not what I'm saying. I'm saying this is a radioactive zone, so stay away. Another name we're talking about in auto news, GM. GM revealed the Corvette Electric, I guess, and they're calling it the new Chevy Corvette E-Ray, which starts at $104,000 a pop, and that is the basic model. Are you kidding me? Who the hell is going to buy this shit? On the other hand, why not buy a souffle? Souffles are getting really, really cheap right now with the recent discount. And of course, the media says this is bad news for Elon Musk. Elon Musk's back is against the wall. We know why they're saying all of this. They were kissing Elon's ass just 2 years ago. Now that he took their propaganda machine, they're pissed off at him and they say, oh, Elon's back is against the wall. Maybe that is the case. And indeed, we have a problem in Tesla. Make no mistake. The demand went down big, we have an oversupply problem, and therefore Tesla is cutting prices big time, which will worsen their margins. That goes without saying. In the meantime, can a reduction in price revive some demand? The answer is absolutely yes. And this is exactly what we're seeing from China. Tesla's retail sales in China surged after price cut, which means bad news for Tesla's competitors, NIO, Li Auto, BYD. And here, in this country, bad news for GM, bad news for Ford, bad news for Stellantis. Oh, wait a minute, nobody cares about Stellantis anyways. But bad news for GM and Ford. Good news for the souffle. And therefore, my hunch is the stock continues to outperform. We see a short covering rally all the way heading into earnings. And then maybe at that time, the stock becomes a short once again. On to the heat map for the ETFs. What do we see here? A muted reaction across the board, be it growth, still outperforming value. But look, we're seeing the recent outperformers in the XLY industrials down, in the XLB for materials down, XBI down, the recent outperformers in technology, XLK, and the SMH for chips, they're muted today. And we're seeing some movement, some action. In the laggards year to date, we're talking about the XLP for staples, XLU for utilities, real estate, even the XLV. Not bad today, was getting hammered in the last few weeks. So is it the beginning of a rotation out of the winners year to date into the losers year to date? This is exactly what I'll be looking for from this point on. Now let's talk about commodities and let's talk about natural gas ETFs, which happen to be the outperformers for today. The UNG up by over 4% and BOIL, the ticker BOIL, is also up for the day by over 5.5%. Now folks, when you're trading leveraged indices, be it the TQQQs, in this case it is a bullish tracker for the actual Qs, the Nasdaq, it runs 3 times what the Qs do in a single day. If the Q's up by 1%, the TQQQs will be up by 3%, and then it resets by the end of the day. And the same goes for the SQQQs, which is a tracker for the actual Qs, but this time around it is a bearish one, which a lot of you use. It tracks the Qs. If the Qs goes down by 1%, SQQQs goes higher by 3%, and then it resets. There is this misunderstanding among the retail community that, oh, if you want to boost your gains, if you want to accelerate your gains beyond what the Qs makes in a year, for example, buy the TQQQs because it is 3 times what the Qs makes. That is a misunderstanding. It only makes 3 times what the Qs make in a single day, and then it resets the very next day. Likewise, when the Qs goes down, TQQQs will go down 3 times the percentage of the downside in the Qs, and then it resets the next day. In other words, the majority of these leveraged indices are meant to be traded on day-to-day basis. You only own them if you have high conviction in a certain move one way or the other. If you have high conviction that the triple Qs is about to go down by about 10% in a straight line, yes, it makes sense that you're going to buy the SQQQs and hold it for a few days until the move is over, because your gains will be amplified this way. Likewise, if you believe that the Qs will run in a massive bear market rally, for example, in a straight line, a rally worth 10%, you're better off playing it by using the TQQQs because your gains will be amplified. Now, when it comes to natural gas and the ticker BOIL, which a lot of you love to play, I do play it too. I played it today twice. This is a high volatility index. It tracks a lot of swaps. It is meant to be played for massive, big moves for natural gas, one way or the other, whether be it long or short. Buying the underlying index, BOIL, you're going to play it in the long side. If we see a massive pop in natural gas, BOIL will appreciate handsomely. If we have a big drop in natural gas and you buy put options this time around in the name, it's going to go down big. But in this case, to clarify, let's say that you are bullish on natural gas. Maybe you believe that the recent pullback in natural gas is overdone. And now that we have the Freeport LNG facility back online, this is a positive catalyst for natural gas futures to move higher. Now you want to amplify your gains, and this is why you're buying call options on BOIL. You buy them midday. The ticker moves higher by 0.5 percentage point, yet your call options are down by 30-40%. Why does this happen? Because this index is not meant to be traded this way. To begin with, trading options on leveraged and high volatility indices is a high risk strategy. You only play them if you have high conviction. In the ticker of BOIL, if you believe that natural gas is going to pop overnight, you buy the ticker before the close, you dump it right at the open, because we see a big pop for BOIL right after the open, and then it cools down. As it cools down, your options are going to depreciate in value dramatically. For example, here's the chart of BOIL. 30 minutes. We have what it appears to be a saucer bottoming formation, in which the chart is making higher lows. Let's say the bet is we see a pop tomorrow in BOIL. You buy the calls right before the close, you dump them in the morning. If the trade goes the other way, you exit right away, because holding on these calls will cost you even more. This is how you trade options on these high volatility indices. Now, another less risky strategy to play BOIL, let's say if you believe that natural gas will end the week up by 20%. This is a big rally. You want to amplify your gains. Instead of buying call options for BOIL, because you're not a day trader, for example, you buy the underlying ETF. And instead of buy, I should say rent. You rent BOIL. You look at the weekly chart, we have a big gap at around 17.78. Now, we know, historically speaking, from a technical analysis perspective, that the majority of gaps left on the way to the downside, more than not, they get filled. So let's say that the bet is natural gas rebounds higher, Freeport optimism, and we see the gap of 17.78 in BOIL filled in this rally. So you're betting for the name to move from the current price of 11.35 to 17.78. This is an impressive rally. Instead of buying natural gas futures, you might want to buy BOIL, but you gotta have high conviction that this will be a straight up rally. A big prop, short covering, it lasts for a few days. Then you buy the name. The actual ETF, not calls, not options. You play it until the move is done, you get to your target, and you get out right away. Because if the rally in natural gas stalls and we see nat gas moving by 1% after a big move or half a percentage after a massive move, more likely than not, BOIL will start to stall too, if not move to the downside. And in that case, you don't want to lose your gains. So we talked about a high risk strategy, which is using call options on a high volatility index. We talked about a less risky strategy of buying the actual high volatility index. Now, the least risky strategy, if you believe that we have a run in natural gas coming, how about you buy some call options or even buy the underlying stock of individual natural gas companies? You got a lot of names. You got EOG, you got EQT, you got SWN, you got Coterra, CTRA. So you have all of these strategies that I just presented for you if you believe that natural gas is moving higher. And I should have clarified all of this before I made that dumb tweet. So my bad, I apologize for that. I should have clarified how to trade these indices, how to play these rallies. We have traders of all shapes and sizes. Some prefer the high risk, high reward strategies. On the other hand, we have other traders who are not as risk tolerant as these traders, and they prefer other strategies. I hope this was clear. And now that we talked about charts, let's segue to the segment of charts analysis, and we begin with SPY, the S&P 500 30 minutes chart. What do we see here? Last night I talked about perhaps this is a good point to book some profits here if you've been playing the rally year to date. And the reason is we have overbought conditions on the RSI, the momentum indicators, indicating that this rally is running out of gas. Number 2, 398 is a stiff resistance. And you gotta respect the line. You gotta respect such important numbers, be it support or resistance. You can't just blast above them or below them in the case of support without paying the respect that such a number deserves. In this case, 398 as resistance this time around. On top of that, today the chart formed a bear flag pattern. More likely than not, we're gonna see a pullback. The chart needs to go down, revisit perhaps the most immediate support at 393.16. See if we have more buyers waiting on the sideline. And if we do, we have a rebound and higher we go. And now that the chart paid the respect that 398 deserves, it has the permission to proceed and move higher. But what if the chart goes down to 393.16, doesn't find the support? Then it has to go down to 391. What if it doesn't find support there? It has to close the gap below at around 390. If it doesn't find support there, it goes down to the next support of 385. It is a step-by-step process that we track and play daily. And for now, the chart is saying, more likely than not, we have a pullback coming. And that is, by the way, confirmed by the daily chart of the continuous contract of the S&P 500. We talked about the top of a breakdown candle, which happens to be 4,037, as an important resistance for now. And the chart did stall pretty much as close as it can get to this number. We're seeing the RSI running out of gas, stalling, moving down by a little bit. We're seeing the MACD stabilizing, indicating that this move is also running out of gas. The best of the move is behind us, not ahead of us, at least for now. The risk versus reward says, if you've been long, take some chips off the table. But the risk versus reward doesn't say for now that you should go all in shorting this move. Because number one, the momentum indicators remain positive. The volume is not surging big time. The VIX remains below 20, and the chart did not lose any important support line yet. In this case, 3,960. When we look at the weekly chart for the SPX, the cash index for the S&P, we're getting exactly at the sloping line of resistance, which has been resistance since the bear market started in 22. The risk versus reward says, once again, it is time to de-risk. It is time to take some chips off the table and wait and see. If the move has the energy to pass above the sloping line of resistance, then you can go back in and you can chase the rally all the way perhaps to 4,325.28. But what if the move runs out of gas right here, right now? Doesn't it make sense to take some profits right now? This is what the market's thinking at the moment. What is the market waiting for to crack above this sloping line of resistance? The answer is How about earnings? It needs a confirmation of some sort before it makes such a drastic and meaningful and significant move. Cracking above this sloping line of resistance and closing above it, closing above anywhere north of 4,000 on a weekly basis, that will change the sentiment in the market altogether. You can't make such a move without having a fundamental catalyst as a piece of evidence. So we're waiting and seeing until earnings, or the majority, most important earnings, are out of the way. Now, is it a signal? Is it a reason to start shorting right now? The answer is absolutely not. Not until we see a weekly closing below 3,800. You can play the pullbacks. You can buy put options, flip them right away. But you don't want to commit serious capital betting against the SPX until the chart closes below 3,800 once and for all. What about the Qs? 30 minutes chart, what do we see here? The same discussion is applicable here. Running out of gas. In this case, the RSI is slightly in negative divergence. It is still overbought. And while the chart is above the important resistance of 280, it needs to pay the respect that 280 deserves, be it a support right now. In other words, that could happen by consolidation around 280, asking for support, asking for buyers waiting on the sidelines to hop in. If it appears that the buyers are not going to show up at 280, and more likely than not, this could be the case because we have a bear flag consolidation pattern right now, then the chart needs to go down to a prior point of support and ask for buyers there. If it does find buyers at whatever point of support, it will move above 280 again. But for now, the risk versus reward says a pullback is imminent. Here's the daily chart for the continuous contract for the Nasdaq. While the volume remains okay, we're not seeing a big surge one way or the other. While the momentum indicators remain positive, they're stalling. They're running out of gas. The chart is facing an important resistance line at 11,689. You gotta pay the number the respect it deserves. At least a bull flag consolidation pattern underneath the number, if not pulling back in an ABC pattern to find the support before cracking above it. In all what I said so far, do you get any indication for now that you should short the Qs? The answer is not quite. And the reason is, we don't have a reversal pattern. We don't have any indicator this rally is done. All what we have indicators for is we do have a pullback imminent, and that's it. Could it morph into a reversal? The answer is absolutely yes, but it requires a fundamental catalyst. It requires a tech name bombing, such as Netflix, such as Apple, such as Microsoft, and that has yet to come. So for now, my outlook is a pullback, perhaps some consolidation, some boring action until we get the major earnings out of the way. IWM, Russell 2000, 30 minutes chart, what do we see here? Similar story. It got all the way almost to my resistance number at 188. And then it pulled back and it is consolidating in a mini bear flag pattern. But this has been an impressive rally so far out of 174.22. We're now at 186.83. What more do you want? If you've been playing this rally, it is time to book some profits. We have a negative divergence on the RSI. We have earnings uncertainty coming. Take some profits. Wait in the sidelines for further clarity. And if you're going to play some puts in the IWM, make sure that they're tight. Make sure that your target is 183 as the next support. Dixie, the dollar index, a daily chart. What do we see here? It is in negative momentum territory, be it in the RSI or the MACD indicator. It is below 103. Dollar bears are now in charge. But it appears that the dollar found some footing here. The dollar is now debating, waiting and seeing if any of the Fed zombies will come out and lift the dollar higher. Because if the dollar flushes down, it will be an absolute disaster commodities-wise. They will move higher in price, and inflation will move higher too. The action we're seeing today is the dollar saying, hey, Fed zombies, anybody wants to rescue me right now? Otherwise, I'm going down. I'm going down to perhaps all the way to 99.9, let's say 100. Okay? Anybody wants to rescue the dollar right now, this is your window for opportunity. And therefore, we're seeing a pullback from gold. This is a daily chart. It pulled back exactly from the resistance of Fibonacci. If I recall the number, it is, I believe, 1928. The high in gold today was almost 1929. And now we have a pullback. So we have this game of wait and see. Gold says, okay, dollar, let's see if you're going to have any rescuer coming. If you don't, I'm going to go higher again. But if you do have a rescue mission coming, I'm going to go down looking for support. And the next support is going to be all the way down at 1,842. Therefore, I'd rather go with oil, in this case UK oil daily chart, because even if the dollar moves higher in a rebound by a little bit, we could see oil continuing in the rally ahead, because besides the dollar, we have two other catalysts in play right now in the US dollar. Number one, we have the refilling of the SPR. Number two, we have China reopening. So even if the dollar rebounds higher, the two other catalysts, the two other tailwinds will keep a floor on oil to continue to move higher. For now, we're seeing a pattern of higher lows. We haven't seen higher highs yet. Maybe that's coming tomorrow. What I see right now, the most important achievement for oil right now is recapturing 85 as support. What about the 10-year yield? What do we have here? It is above 3.5 once again. Is it out of the woods? Is it moving higher again? Too early to say. These charts are all waiting for a catalyst. We talked about the dollar moving down, waiting for a rescue operation. The 10-year is also waiting for more clarity by the Fed. Do you want me to go down? Do you want me to go higher again? Am I even tracking the Fed anymore? Am I tracking the Fed hike expectations anymore? Or am I tracking the fundamentals of the economy? This is what the 10-year is thinking right now. If it is the latter, 10-year goes down in expectation of a recession. So at some point you will see the 10-year moving down, yet equities reacting negatively. That will be the moment that we know for sure the market is shifting into a recession theme. TLT, a daily chart, what's going on here? What's going on is nothing. Yes, we have a pop higher above the important support of 103.5. But maybe it needs to go down in a retest of 103.5 once again. And therefore, I'm out of the way. I'm not playing this one way or the other. I'm waiting until I see the TLT above 109.5, closing above it from weekly basis. Then I'll be in. What about the VIX 4 hours chart? What do we see here? Immediately, the moment it closed below 20 by a lot, we're seeing folks buying puts on the SPY, buying puts on whatever stocks they own, and the VIX popped higher, got to 20. It faced some resistance and pulled back. But all in all, we see the MACD indicator, at least from a 4 hours perspective, moving back into positive territory, indicating positive momentum coming. We have what it appears to be a bull flag pattern. In other words, the risk versus reward says VIX popping higher, SPY pulling back. What about Apple? 30 minutes chart, what do we see here? It cracked above 134.37. It filled the gap at 135.36 and it closed above this number. But in doing so, forming a bear flag pattern. The risk versus reward once again says Apple is going to pull back. Maybe the pullback is not going to be aggressive. Maybe it pulls back to 134.37 again. But until we get earnings out of the way, I'm not expecting a big move one way or the other here. Tesla, 30 minutes chart, what do we have? We're using a line chart because the pattern is clear. It is off a reverse head and shoulder. We have a crack above an important resistance, now support 128.62. Now in typical charting behavior, breaking above an important support or a resistance line is usually followed by a retest. I wouldn't be surprised if Tesla pulls back tomorrow in a retest of this line. But all in all, the chart is looking positive. The momentum is to the upside until earnings in this name. Last but not least, tulips, Bitcoin, a daily chart. What do we have here? Still above the important number, 20,593.34. It actually went down in a retest to that number and it moved higher. So far, so good. The problem is, it cannot really get rid of this overbought condition in the technicals. This is going to play sooner or later. And therefore, the risk versus reward says this move higher is out of proportions and it happened too soon, too fast. A lot of us missed it. And the risk versus reward says you're better off waiting for a pullback. Let's see where the pullback is going to lead us. Will 20,593.34 hold again? Will it be below this number? The likelihood is it's going to be below this number. Is it going to be 19,000? Is it going to be 18,500? If it rebounds from that point on, so far, so good. It's giving you the buying opportunity to hop back in at a better price. But if it breaks 18,500, if it starts going below that, then all what we're seeing is a dead cat bounce. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have a lot. We have retail sales. We have the PPI, the Producer Price Index. We have industrial production along with capacity utilization. We have the Home Builders Index along with the Fed's Beige Book, which comes with a bunch of Fed zombies speaking. The most important one is St. Louis Fed President James Bullard, who will be interviewed by the Wall Street Journal. But we also have from the Philly Fed, President Harker, along with the new Dallas Fed President Lori Logan, who's replacing the drunk chairman, if you remember, Bob Kaplan, insider trader Kaplan. Anyhow, what do we have on the earnings calendar? We have JB Hunt, an important indicator for the health of the economy. We also have Schwab. We saw the disaster with Goldman Sachs. Will there be yet another disaster in Schwab? Then we have another indicator for the health of the global economy this time around, and perhaps maybe the Russian economy and the demand for aluminum in Alcoa. And with that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
Hey, Goldman Sachs. On behalf of the American middle class, you.